anchor clients, which are like top brands of the country, including Adani Group, JSW, Tata Group, Whirlpool, Kacharia, MG Hector, multiple brands from multiple sectors whose distributors are empaneled with us, and we have been able to offer this product of supply chain funding to them. And at the same time, we are equally proud to be able to establish a full tech stack to achieve these milestones and run our business model. Because with the team of less than 100 people, we have been able to discount almost 400,000 invoices which are related to multiple clients and their multiple distributors. So we are fully geared up to take the current loan book, which stands at 2,600 crores, to 3,500, 4,000 crores by FY26 and 6,000 crores in the following year, and in 7 months through preferential equity infusion, which is a residual amount of warrant conversion, and being able to achieve a AA rating from top credit agencies. We have a list of all the top national banks whose borrowings are with us. So we are confident that we should be able to achieve a 6,000 crores loan book by end of FY27, with maintaining 15% to 18% ROE and 4.5% ROA. So that's all from me. Saurabh, over to you to take investors through Q1.
Thank you, Anubhav. Thanks, Shreepal, for hosting this call for us. Good afternoon, everyone, and thank you for joining us today. It gives me an immense pleasure to take you through the Q1FY26 numbers of SG Finserve. I think we began the year on a strong footing, and delighted to share that our performance this quarter truly reflects the momentum we built over the last 34 months. Grounded in execution discipline, technology-led operations, as we continue to keep sharp focus on MSME supply chain financing. The performance for Q1FY26, we closed AUM of 2,630 crores as of 30th June. That's a 13% quarter-on-quarter increase and an 86% year-on-year increase. Gross disbursements during the quarter stood at 5,284 crores. Operating income came in at 67.59 crores, which is up by 25% quarter-on-quarter basis and 55% year-on-year basis. Net interest income rose to 42.79 crores, a 20% increase over Q4FY25. Profit after tax stood at 24.52 crores, a 3% growth quarter-on-quarter and 27% growth year-on-year basis. Gross NPAs remained at nil, showcasing the strength of our secured anchor-led book. Annualized ROA stood at 4.68% and ROE was 9.54% for the quarter. These numbers reaffirm our conviction in this high-velocity, low-risk model tailored for MSMEs through supply chain financing solutions. So some of the strategic progressions achieved in the quarter include: we've grown our MOU portfolio to now 6,400 crores, up by 900 crores over the previous quarter. The anchor network has further grown. Now we have tie-ups with 48 leading corporates, up from 44 last time. And this is spread across infra space, metals, auto, consumer durables, electronics, IT peripherals, etc. 80% of our book is secured, backed by inventory or receivables with strong stop supply arrangements in place. The average book churn during Q1 remained at about 30 days, improved from 36 days last quarter. ensuring high velocity and quick cash cycles. Further, as we continue to build a digitally native NBFC, we are happy to say that we've launched our customer mobile app, enabling real-time access to loans, statements, and servicing for our borrowers. Our AI-driven credit monitoring tool will also go live by September 25 to further strengthen our portfolio oversight. The proprietary credit rating model, the scoring engine, continues to enable precision lending and faster tax for us. As Anubhav also mentioned, capital is a key ingredient for raising debt. We continue to hold it strong at about 1050 crores standing today, and another 340 crores expected to come in by April 26. We are actively working to expand our banking lines to 4500 crores targeted for FY27 from the current sanctioned limits of about 1800 crores. Our credit ratings of AA and A1 plus from both CRISIL and ICRA continue to stand strong. So the way forward for the company looks bright. We're well positioned to achieve AUM of FY26 of about 35 to 4,000 crores. This confidence stems from we strategically added 12 new locations considering anchor requirements, need for penetration of existing anchors, and at present 225 kilometers is the coverage radius, which shall reduce to about 150 kilometers. Tier 2 penetration has started, so we started to place manpower at Tier 1 business hubs and start penetrating the Tier 2. So deep anchor integration with existing MOUs of 6,500 crore and increasing further on month-on-month basis. Strong risk and compliance systems, a scalable tech lending platform, and capital adequacy. Considering all this, we remain committed to driving profitable growth, enabling MSMEs and becoming India's leading supply chain financing one-stop solution provider. Thus, as a closing note, I want to sincerely thank each one of you, our shareholders, lenders, anchors, and employees, for your trust in our journey. Your belief has powered us to move faster, think bigger, and deliver better. As always, we remain committed to transparency, discipline, and long-term value creation. Thank you so much, and with that, we now open the floor for your questions, please.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone phone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Rehan Syed from Trinetra Asset Manager. Please go ahead.
Oh, yeah, good afternoon, team, and congratulations for a good set of numbers, and thank you for giving me the opportunity. So, sir, I have a couple of questions. First of all, on the P&L side, like your net interest income rose by 20% quarter on quarter, yet that only grew by 3%. So, what were the key margin pressures preventing bottom line expansion in this quarter? If you just can elaborate more on this.
Thanks, Rehan, for your question. The P&L, so there is a one-time cost of ESOPs, which is about 2.7 crores, which is taken in this quarter, and otherwise the PAT would have increased and and there would have been a similar growth to NII. So there is a 2.7 crore cost of ESOPs, which is taken Q1.
So this is the same as our operating expense also rose by 24% quarter on quarter. So is it the same thing that you are mentioning here? Like, can you share a detailed breakup, especially on employee tech or geography expansion cost drivers regarding this?
So employee cost has only increased by 10% quarter on quarter basis. It is there is a so that is the salary was about at 2.3 quarter. It has increased to 2.62 crores. There is a ESOP cost of 2.72 crores in Q1, and that is the reason the employee cost is on the higher side.
Okay. Okay. Thank you. And my second question is around could you please share the current product mix split between the dealer finance, better finance, and invoice discounting? Which segment is growing faster?
So the supply chain financing for us constitutes about 85% of our book, with major focus
Yes.
is on dealer financing. So out of that, about 90% of our book would constitute dealer financing only. So our main forte is conducting dealer financing portfolio only.
Okay. Okay. And the third question is regarding around given the North India still forms 40% of the loan book. So could you share region-wide asset quality or yield differential insights, if any? You can just put it in here.
Sorry, Rehan, can you come back again with your question? Your voice is not clear, yeah.
Yeah, sure. I'll repeat my question again. So given North India still forms 40% of your loan book, could you share region-wide asset quality or yield differential insights, if you can just put in some insight or some light on that?
Okay, for the region-wise asset quality, if you see, South is our best performing portfolio, and we will continue to increase more locations there as well as elsewhere. Then second comes the North. Then lastly, West. Our asset quality overall remains in line with what we have achieved so far in previous quarters, and has not deteriorated any further. Our delinquencies in 0 to 30 and 30 to 60 are at similar levels as was there previously. 60 to 90 days, we do not have any delinquencies currently. Similarly, the NPAs across all the 4 zones are nil.
Okay. Okay, sir. Thank you for your detailed answer, and wish you all the best for coming quarter. Thank you. Thank you very much.
Thank you, Rehan.
Thank you. The next question is from the line of Vaibhav Mishra from Fine Lights. Please go ahead.
Congratulations, sir, on the decent set of numbers. So my question is regarding the growth that we had planned or anticipated for Q1. We were planning something around 400 to 500 crores of AUM growth and around 10 to 12 crores of PAT addition on the base of Q4 PAT. So we have, I think, somewhat missed that. So what could be the reason? And also, sir, disbursement growth, if you see, it's around 5% only on Q4. So the reasons for that?
So thanks, Vaibhav, for your question. We never given guidance for Q1 separately. The guidance was given for FY26 as a whole, where we look at doing 4,000 crores, and we still stand by it. The sanctioned limits in Q1 were much higher, but some of the new models or new product launches of some of the anchors got delayed and have moved to the month of July. So that's about 150 crores to 175 crores, which got staggered. And on the PAT, we mentioned that there was a one-time ESOP cost of about 2.7 crores. Otherwise, we were looking at doing about 27 to 27.5 crores for the Q1.
Okay, so sir, are we still on track to achieve 200 crores of PAT in 26?
No, so Vaibhav, I mean, what we say is that on 4,000 crore loan book, right, the average loan book for the full year will be somewhere around 3,000 crores, right? We ended FY25 at 2,000 somewhere, right, and the exit loan book will be around 4,000 crores. So average will be 3,000 crore based on 1,500 crore kind of average net worth. And the balance from the debt, we should be near about 160 crore, 150, 160 crore kind of PAT level, if you do the maths.
See, well, that was considering that's considering the net worth of 1,500 crores, but as you know, that we've not called in for the warrant balance money. The same will come in only in April 26. So in financial year 26, we will continue to have a net worth of about 1050 crores. So, and our yield, if you'll see, is up about 12.9%. So, and about 1000 crores, 1050 crores would be equity, and balance 2000 crores of average debt, wherein we're keeping a spread of about 4 to 4.5%. So that is what the interest income would look like.
All right, sir. All right. Okay. Thank you so much, sir.
Thank you. The next question is from the line of Pratik Sen from Dexter Capital. Please go ahead.
Thank you for the opportunity, sir. So roughly 80% of our book is secured. Can you help me understand how this securitization actually works in this case? Like if these loans are secured against inventory or receivable, how do we track the movement of inventory and invoices? Especially for non-APL Apollo Group distributors, because there we would not have direct access to data, right?
Thanks, Pratik, for your question. Yes, 80% of our book is secured through inventory and receivables generated thereon. When we say that we have disbursed to close to about 47,000 crores, the entire 47,000 crores, whether it is APL, non-APL, Tata Group, Adani, every penny from our counter directly goes to the anchor, and the anchor supplies material to the dealers. So that is how the movement of inventory is ensured, because we are not giving even a single penny in the hands of the dealer. Every penny goes to the anchor, and anchor supplies us with the invoices, wherein and with proof of delivery that the material has been delivered to the dealer.
Okay. And will our OPEX need to scale at the same pace with the AUM growth? How should we think about the OPEX going forward?
See, OPEX, if we look at the quarter one, with an expense of about 8 odd crores, we feel that even if we go to a book of about 6,000 crores, the OPEX would, so right now our OPEX cost is about 70 to 75 basis point. At 6,000 crore, we feel that the OPEX cost would be about down to about 50 basis points. With economies of scale, with increase of book, the overall OPEX cost would reduce.
Understood. And last question from my side. So, what exactly is the incentive for the anchor to agree to sign the stop of supply MOU? And have we ever exercised that clause?
Stop supply, yes. Have we exercised? Answer is yes. And we've been able, we've done it successfully. And it is a trigger which works in our favor, because when the material is not supplied to the dealers, come what may, they start repaying us in case of any delay. Yes, it works. And why do the anchors sign up? I think it is how the industry has evolved, that majority of the lenders do not want to finance without this MOU being in place. And we being part of the same industry, we've also kept it as a precondition before doing any, before going to the dealers. We do not go without the MOU being in place.
Okay. Thank you, sir. I will get back in queue.
Thank you very much. The next question is from the line of Anil Shirin from company K16 Advisors. Please go ahead.
Good morning, gentlemen. First of all, congratulations on very good results, especially in a period when other NBFCs and banks are showing a slowdown in advances growth. You have shown very good advances growth, so it is to your credit. My question was regarding how do you calculate the yield? Because when I try to calculate, I take the average of the loan book as it existed on 31st March and on 30th June. I take the average of that and I divide the interest income by that average. I get a figure of 10.5% annualized. Whereas the correct figure is, as for you, it is 12.9. So if you could help me bridge this gap, it would be very useful for me.
Sure. Thank you, Anilji. Your words are really motivating. The average yield, the ROA tree, is calculated basis daily average book throughout the quarter. So 31st March, then the book might have lowered down, but the actual number is 12.9. 12.4 is plus processing fee, yield on the processing fee, but that's calculated basis the daily average outstanding loan book on actual basis.
No, but why am I getting 10.5% and not 12.9%?
Because you calculating it 31st March, you calculating the EOP book. What we doing is we calculating book on average daily basis. So what was the book on outstanding book on 1st April, 2nd April on daily basis? What is the average book? And that is the number that we're taking.
Okay, fine. One more question is regarding the ESOP expenses which have been charged in the first quarter. I'd request you to help me with the residual amount for the rest of the year and for the following year, fiscal 27. What would be the total ESOP charge for the rest of the year and for the coming fiscal year, that is fiscal 27?
So in the current financial year, the charge would be about 9.9 to 10 crore rupees. And in FY27, the same will reduce down to less than 1 crore rupees. There is a bunching up of ESOPs which are due in the current financial year. That is why the charged amount would be higher in the current financial year, but the same would reduce by about 9 odd crores in the next financial year.
Okay, fantastic. So this is the year when we have to sort of cross the hump, and next year onwards the OPEX ratio would fall quite a bit, and that will have its beneficial impact on the return on assets.
Absolutely.
Okay. So just one last thing. We started very well, 13% QOQ growth in loan book and AUM, and we hope to end at 4,000. So the ask is, it's even higher. The ask, the required growth rate for the rest of the year is even higher. So I just had this question that, fine, you are adding anchors, you are going deeper into the hinterland, and you are also working with the anchors to increase the arrangement of MSME funding, which is all for the good. But in the light of the slowdown across the economy, how confident are you to take the QOQ loan book growth rate even higher than what you have already achieved in the first quarter?
We were looking at, to be honest, we would have done a closing loan book much higher than this. I think a couple of anchors, their product launches got deferred to this quarter, and we missed about 150 to 175 crores due to that. I think the sectors that we are operating in, automobile and building materials, both are running quite active. And another encouraging point is that our conversion days, which was at 36 days, has reduced to about 30 days. That is also one encouraging point, that the cash cycle conversion is also down. So we are confident, and we want to do 4,000 crores for this financial year.
So in addition to that, the total program size that we have signed is around 6,400 crores. So by achieving an AUM of around 2,500, 2,600 crores, we are still not even 50% of that overall program size. Secondly, there are other anchors which are in pipelines from whom we expect a lot of transactions to happen, and that will thus we are confident of achieving that number that for which we have given the guidance.
So the way I look at it, SG Finserve has 2 or 3 main advantages. But the biggest advantage is that you have a captive borrower base. Other NBFCs have to pay DSA charges, whereas you, due to the backing and due to your business model, are dealing direct. So you save on that. And the second is that you are so digital. Your OPEX ratio is modest, and it will remain modest So both these things, coupled with a low cost of debt, I think the future is very bright for our company. So congratulations on the same. Thank you. I have no more questions.
Thank you so much, sir. Thank you.
Thank you. The next question is from the line of Akash from Mandip Securities. Please go ahead.
Hello. Sir, so I wanted to know this average yield, if you are saying it was around 12.9% for this quarter. So that means that our average loan book, outstanding loan book, have been around 2000 CR for this quarter, which is even below than 31st March end of point. Hello?
Yes. Hi, Akash.
Yeah. So, sir, this end of point number is very misleading because these let's say at 31st March you had outstanding loan book of 2,300 CR, and out of this 400-500 crore of loan book got closed immediately next week or after 2 weeks. Because your average outstanding loan book seems to be around 2,000 CR for Q1. So instead of this end of point number, can you report average loan book for the entire quarter? That will be a better, clear picture for the company.
Sure, we will start circulating the average loan book numbers also. Yes, there was a dip. So average loan book is about 2,100 to 2,200 crores. And there were some investments also which we had withdrawn after the quarter because there was a requirement on the loan book side. And but now the book is quite stable at Q1 ending.
No, but sir, this average yield you are telling 12.9%, does it include processing fees?
Yes, 12.9 also includes processing fees, which has also gone up in the current quarter.
Okay, then your average loan book was around 2,100 CR, which is below end of point loan book of 31st March. So there was no net addition this quarter. So this end of point loan book, my point is this end of point loan book is very misleading. It does not reflect true picture. I would rather like to know average outstanding loan book for the quarter. That will be a true picture.
So we'll start posting that.
Yeah, that's all from my side. Thank you.
Thank you. The next question is from the line of Arup Dure, an individual investor. Please go ahead.
In the last quarter, you gave a guidance that when you reach 4,000 crore AUM by the end of FY26, monthly disbursement would reach around 3,000 crore, which is like 9,000 crore per quarter. And that implies a 1,000 crore quarter-on-quarter increase. But in Q1 FY26, the disbursement grew by only 200 crore. Okay. So could you explain the gap between the guidance and the execution, and any updated guidance you could share would be helpful.
Thank you, Arunji, for your question. Disbursement has not grown by much. However, the guidance for the upcoming quarters remains intact. But I believe that the major point of looking at our book would be end of period book and the average loan book, then the disbursements, because the disbursement is a subset of how much repayments are received in the counter. We are allowing about 90 days to each of our borrowers, and sometimes during the off-season times, they can avail good 60, 65, 70 days, and usually we see that they repay the book in 30 to 35 days. Basis that, we had given our guidance that the disbursement number would be higher, but I would request that we focus more on the EOP and the average loan book, which suggested by one of the other callers before this call. We would start posting that as well. So disbursement is based on how the cycles are performing, and that is why the number can be up and below sometimes.
Okay, sir. Thank you.
Thank you. The next question is from Gaurav Vidwania, Code Advisors LLP. Please go ahead.
Thank you for taking my question. My question is, I see, significant jump in the finance cost. I think roughly going up about 30-35%. Now, on the last call, you had mentioned that, the entire quarter for Q4, the promoter debt, had gone down to almost zero, and it was 100% market rate debt. So, just want to understand the reason for the increase in the finance cost.
Thank you for your question. Right, the promoter debt is absolutely zero. The finance cost includes a major portion of processing fee, which we include in our P&L on actual basis. But however, a lot of these debts are taken for 1 year. However, the processing fee has been included in Q1 itself, and that is the reason for a higher financial cost. But on overall basis, we can assure you that we've been able to reduce cost of funds by about 30 basis points from last quarter to end of this quarter. So average is down by about 30 basis points.
So for the finance cost, as we leverage more and as we increase the size of the debt on our books, the finance cost is ought to increase. But the more important point, as Saurabh mentioned here, is that the pricing at which the cost of debt at which we are borrowing, which is gradually reducing, and that is where the progress has been made.
Got it. So I think earlier you were also talking about sharing an average period for the loan book. Maybe if you have something on the loans as well, that would be helpful for us to compare, just to see if the amount has gone up significantly or that has not gone up.
Okay, so I'll just share with you the processing fee charged in Q1 is 3 crores, right? Yeah, so 3 crores of processing fee has been charged there. We'll start showing the borrowing as you mentioned. Right.
Got it. And the 3 crores, so is that going to be a recurring charge? Can we expect this kind of impact going forward?
No, it will not be recurring. It is only one time. It is the additional debt that has been sanctioned by banks, wherein we have paid one-time processing fee. But these loans are going to continue 1 year, and so it is only one-time fee, but we take it on actual basis.
Got it. This is helpful. Thank you so much.
Thank you. The next question is from Akhilesh Kumar, an individual investor. Please go ahead.
Hello. I have first question on ESOP, what you mentioned that has impacted our bottom line this quarter, and you projected for this entire financial year it will be something total 9 point something crore. So do you think it will be we will be able to see any growth in PAT itself, or it will be like say 25 odd crores every quarter because of that impact of ESOPs?
So for this financial year, yes, because the ESOPs have bunched up in this financial year, the cost or the provision on account of ESOPs will be higher than the previous as well as the future financial year. However, the PAT and the interest income will be in line with the AUM growth. So, of course, the PAT ought to increase in further quarters, but yes, and it will be a factor of only the AUM growth. However, there will be some suppression on account of the higher provision on account of the ESOP.
Okay. Would have been better, like it would have been staggered over the next couple of years rather than pumping everything in 1 year?
No, they are staggered over years, but however, in this particular financial year, the bunching up is higher than the financial years ahead.
Okay, and I would like to know one more thing. Like we are claiming that we are say APL Apollo Group company, but I don't see any promoter of APL Apollo is a promoter here. So what is their stake here? Like that we are not seeing except the bank guarantees what APL Apollo has provided.
No, Rohan Gupta is a director in the company, and Rohan Gupta is son of Sanjay Gupta ji, and Rohan and Rahul, the elder son, put together, they hold about 48% stake in the company.
Also to mention, there are no bank guarantees. It's the entire supply chain finance as it runs in the industry, whether for APL or for anybody else, is a non-recourse program with stop supply arrangement in place.
Okay, and thanks for clarifying about the family dispute relations. So that brings up the ownership from APL Apollo indirectly. And what about Mr. Sahil Gupta? He is a non-promoter here, but he is a promoter in SG Mart, and I'm not sure, like, few of the family members are staggered as a non-promoters as well.
Yeah, so Sahil Gupta is under the non-promoter. He's son of Sanjay Ji's brother's son. So he's classified as a non-promoter because the company is promoted by Sanjay Ji's sons only.
Okay, great. And this AUM growth, what you suggested that we will pick up in this quarter. So would you be like, it will be kind of, you have any projection for a couple of quarters ahead, like it will be growth, like it will be towards H2 better than in the second quarter, like that?
See, every quarter, if you're standing at a AUM today, every quarter we will be growing our AUM, and the PAT has to improve only from here. And we would see that every quarter we've been performing in that manner. And similarly, we are extremely positive about the upcoming quarters, basis our ongoing discussions and the pipelines from the anchors. And we expect that we would continue to perform and add more.
Okay, so at end user level, like say we are focused more towards construction industry where we are financing more as or automobile has got better percentage, and which like say they have got some kind of cyclicality, like in monsoons they have got impact and all. Can you guide on that?
So we are more focused on building material and autos, as both the sectors for us continue to perform well. Cyclicality is there, but then there are upside seasons as well, which would include all the festivals and the quarter ends. So that is the reason the quarter ends, the push sales by the anchor, the book also for us rises at the quarter ends. But yes, there are cycles in place. Monsoons do impact, but there is enough liquidity available, and so the impact on our book, the quality of our book continues to remain strong. The demand from some region might go lower, but as we are so well spread across the country, the demand from the other regions is able to cope up for the same.
Okay. Percentage-wise, can you help on that from the construction and the automobile?
So construction would be about 60% upwards, and auto would be about 20%.
Okay, that's good. One last thing, in auto, what kind of financing we are doing for dealers? Like, I'm not very clear.
So we finance the authorized dealers of the automobile companies to purchase vehicles, which would include commercial vehicles, passenger vehicles, and electric vehicles for their showrooms and for onward sales to the retailers. Okay. So we are funding the authorized dealers only.
Okay. Not the manufacturers or the auto ancillary companies, but the dealers who are in.
We fund the brick and mortar dealers which we see on the roadside.
Okay. Got it. Thank you. Thanks a lot. That's it from me.
Thank you. Before we take the next question, we would like to remind participants you may press star and 1 to ask a question. Thank you. The next question is from Shweta Padi from SBI Securities. Please go ahead.
Yes, sir. Thank you for the opportunity. I just want you to give a more view on the competitive landscape. Since for last few quarters, the growth has been very good. Do you see the financials which are not growing so much are coming into this dealer financing, or how's the competitive landscape?
So when we do comparison with the peer, we can compare, we can categorize them into two parts. One part whom we compete, that is Tata Capital, Aditya Birla, Hero FinCorp.
वो valuation update करना Veritas और SK के लिए.
One is Tata Capital, Aditya Birla, Hero FinCorp, on which we are able to compete on the commercials part. However, since we are more focused on only the supply chain finance, we are sometimes able to win over these other NBFCs. Higher yields than probably. So there are other NBFCs across the country, 3-4 other players who are there, who are probably lending at 16, 17, 18%. However, we are not in that range and we take a lower risk. So for none of our borrowers, when we compete, and if there is a multiple banking arrangement, we come across those NBFCs who have also lent to the borrowers to whom we have lent. So when we compete, yes, on the technology side there are other players with whom we compete, but on the commercial side we win over them. With larger players we are able to compete on the commercial side, but when it is technology, we probably have better technology in place than them.
Vishwada, I think the overall supply chain finance industry is so large that there is space for everybody, and the transition that I think everybody is seeing, that from the open-ended limits, which is cash credit, the bankers are more interested in extending close-ended limits like SCF, wherein we can monitor the end use of funds.
Collateral you are monitoring before lending those loans?
We mentioned 80% of our book is secured by inventory and receivables generated, but when we take exposures more than 5 crores for a borrower, 7.5 crore plus, then we try and extract collateral.
Yeah, thank you so much.
Thank you. Thank you.
Thank you. The next question is from Aryan Mehta from Mehta Investments. Please go ahead.
Hello.
Hi, Aryan.
Yeah. Congratulations on the great quarter. Very impressed by the execution. I wanted to understand something around the moat. So we have onboarded some very large companies as anchors. So when you onboard the anchors, are you the sole supply chain financer for the anchor? I understand that the companies might have their own financing arms, but these financing agreements with the anchors, are they exclusive or no?
So whenever we enter into an anchor-lender relationship, we probably are not the sole players who are present in their channel financing arrangement. There are other financial institutions such as banks, larger NBFCs, and other financial institutions who are already present and competing with us on the same.
Okay, and so for these banks and other institutions, do they also have ERP integration and all of those things?
So it depends on the kind of technology that these banks use. A particular anchor would not be having ERP integration with everybody, but only with players whom he thinks their system is more compatible with.
with them. And I think that has been added to our advantage that we've been able to penetrate because our integrations with their ERPs are more flexible and more user-friendly. So I think that has also been an added advantage than running it the basic brick mortar level. And that's why we mentioned that we've discounted close to about 4 lakh invoices through our counter. And if you look at SCF being done about 5 years back, each of this invoice was coming to the counter and then getting discounted won't have been possible. So I think the transition, the transformation that we've done, the ERP integrations being in place and all of these invoices getting discounted through the counter without any manual interventions, I think that's been one of the major USPs to penetrate these anchors.
Okay, that's great. And so we have a very stringent criteria for selecting borrowers, right? They should have worked for the anchor for 3 to 5 years and should have majority business coming from them. So isn't this like a disadvantage when you actually talk with anchors that, we will only lend to a certain group of borrowers within you, but some other company might give access to a whole lot of borrowers with not such stringent criteria?
I think, see, that is the basis of us doing business, which is protecting the bottom line. And these criterias are decided and are part of each and every MOU, right? So it is after a lot of discussions and negotiations that this MOU is signed, and it will mention the specific criteria. And we also mentioned that we are in the business of taking medium risk and a calculative risk, and that we are taking, but we are not funding all the dealers. There are other financiers who are funding other dealers. We are being very selective, protecting the bottom line.
Okay, thank you. And just one last question. Our current anchor penetration is around 6-7%. So in the next few years, what kind of number are we looking at?
Anchor penetration 6-7%. So anchor penetration, Aryan, how anchor operates is that when these MOUs are signed, these numbers are decided after very careful consideration, and scaling is targeted both by the anchor as well as the financer. So that is the reason that we are also looking at adding.
एंट्री हुए थे अंकी हम बाहर जते रहे चालू अंदर.
Sorry, I think there is someone in the midst of this call. So Arun, as I was mentioning, the numbers which are taken in the MOU are taken after a lot of consideration both by the anchor and financier, and they are a target to be achieved in 12 to 18 months. And we've seen that some of our anchor MOUs, wherein we also had to increase our limits. And the major steps that we are taking from our side is upgrading our tech. So we launched our app also. 2 is adding more manpower at different locations and reducing the availability from 225 kilometers to about 150 kilometers, wherein we can target more dealers, more wholesalers of these anchors, and we look at increasing the penetration every day basis.
All right. Thank you, and all the best.
Thank you.
Thank you. The next question is from Manish Keela, an individual investor. Please go ahead.
Yeah. Thank you for taking up my question. So I have a couple of questions for the management. One, it's been almost 3 years since we took over the existing company, and we are into this lending business, right? So what has been your experience in terms of things that have surprised us on the positive side so far? 2, the ones wherein we had to trim down expectations probably because those did not go as per our plan. And my second question is, are we looking at lending across any other new segments outside of supply chain financing? So these are my 2 questions.
Thank you, Manishi. What has been our experience 3 years? In our last quarter presentation, we had given a specific slide on stating the movement of AUM because of the RBI thing that happened. I think a couple of learnings that we took from that the book has a lot of strength, because bringing down a book from 1900 crores to about 750 crores spoke about the strength. B, it was our suo moto step that we repaid all the banks without them asking for money, and that showed and has strengthened our relationship with all our financiers. And the same has been showcased that all of them, as on date, are back with us, and a lot of them have taken larger exposures than what they had before. So yes, there has been a trim down of, we had expected a different number for the last financial year, but because of that, the small incident that happened, because of that, we had to trim down our expectations. But I think we're not looking back, we're looking forward, and all the anchors are back. I think all of them have left the baggage behind, and we will continue to keep the same momentum and grow quarter on quarter basis. Yeah. Sorry, can you repeat the second question? I think I've answered your first question. If you can help me with the second question once, please.
Yeah. So my second question was, are we looking at lending across any other new segments outside of supply chain financing?
So Manishi, key focus is on supply chain finance. Yes, 15 to 20% outside supply chain finance. We continue to look at that and look at new products also, majorly on the cross-sell side, because now we were a large customer base, and we look at what are the other products that are being availed by them and how we can probably do a collateral-backed loan against property, and look at other products which we can cross-sell after there is a definite track record of the borrower with us. Thank you so much.
Thank you.
Thank you. The next question is from the line of Aryan Mehta from Mehta Investments. Please go ahead.
Hello. Sorry, I just had one follow-up question. So when we say that the anchors work with multiple banks and other lenders, what kind of number could we estimate? So for example, maybe they work with 3 or 4 banks and a couple of other lenders. So is there some number which I can estimate?
So Aryan, it depends on anchor to anchor, how many financiers they want to deal with. The larger the anchor would be, the number of financiers would be more. For example, a Tata Motors would be dealing with about 20 plus financiers, whereas the Automobile would have only 4 financiers. So it would be dependent on the anchor to anchor. But what we want to state is that the need is so much that even if I am the last entrant into Tata Motors, we've been able to add a book of about 300 crores over last 3 months. That means the need of such a large anchor having 20 plus financiers and a 21st person coming in has been able to add 300 crores only in last 3 months. So the need of supply chain finance is the demand for supply chain finance is extremely high in the industry.
Great, that is very helpful. Thank you.
Thank you, Aryan.
Thank you. The next question is from Sumit Jain, an individual investor.
Good afternoon, everyone. Good afternoon, everyone. Thanks for the opportunity. My question is regarding sales commission expense in March 24, which is approx 3.18 crores. I wanted to understand to whom does it, what is the nature of the sales commission, and what is the amount of sales commission in financial year 24 and 25? Hello?
Yeah, just a minute. So for the sales commission expense, some of the transactions we do jointly with other lenders as well in the industry. There are other players, and if the same have been sourced by them, we probably have to pass on some of the income to them as that commission for the sourcing that they have done.
But you'll see that has reduced. In this quarter, it is only 9.45 lakhs. It was in FY24 that was on the higher side, and FY25 it is only 78 lakhs, and in the current quarter it is only 9.45 lakhs. So that tie-up was there initially.
Okay. As I understood, this has been paid in March 24 for the sourcing of clients, for the sourcing of customers from other banks or NBFCs.
Yes. But that has reduced. Now in March 25, it was down to about 78 lakhs, and in the current quarter it is only 9.45 lakhs.
Thanks. No more questions.
Thank you so much.
Yes.
Can we have a last question, please?
Thank you. The next question is from Tushar Verma from Big Shot Investment Private Limited. Please go ahead.
Sorry, I think there is no one on the line for this, right?
Yeah. Oh, sorry. Actually, my line is mute, sir. Am I audible now?
Yes, Tushar, you are audible.
Yeah. Sorry. Thank you for the opportunity, sir. My question is, we have guided for 4,000 crore AUM for FY26 and 6,000 for FY27, but we report yield based on average daily outstanding loan book. So what is the expected average daily loan outstanding book expected for 26 and FY27 and NIM based on that?
So average loan book for 26 is expected to be around 2,900 to 3,000 crores, and average loan book for the next financial year that is expected to be around between 4,800 to 5,000 crores.
Okay, sir. And what was it for FY25?
So average loan book for FY25
last year, 25.
Tushar, we'll just take a couple of seconds.
Okay.
It was about 1,300 crores.
1,300 crores. Okay, sir. Just one remaining part. NIM based on this average loan book for FY26 and 27. That's all from my side.
So we expect a yield of about 12.25% to 12.5%, and our cost of borrowing would be about 8.25%. So we will be making a spread of about 4% on the debt-laden book. The equity portion in 3,000 crores of average book would be about 1,000 crores of equity, and when we do 5,000 crores, the average equity position would be about 1,500 crores.
Okay. Thank you so much, sir, for the clarity. Thank you, sir.
Thank you so much.
Thank you. The next question is from the line of Parit Jain from Lucky Securities. Please go ahead.
Hello, am I audible?
Yeah, you are.
Yeah. Thanks for the opportunity, sir. I just wanted to know what are the other sectors other than automobile and construction that we are looking at, maybe in terms of like industries that have a large dealer base that we can tap once we can saturate the automobile and construction market. construction sector?
We probably are diversifying across sectors. When you come to building material space, we have tied up with players across the industry, such as APL Apollo was the initial one, then JSPL, Sham Metallics, etc. Then Tata BlueScope. When it comes to automobile, there are players which are already displayed. Apart from that, we are growing in IT and peripherals. Then we have tie-up in the mobile segment, and that is what. So for some of the sectors, we are little cautious. For example, in the paint segment, that industry has become very competitive with new entrants. So we are very cautious in that. We deliberately didn't go ahead and tie up, although there were some options available with us. Then in the cement space, that is also little competitive and the landscape is little different. We are little jittery on that space as well. However, we are also expanding in the wires and cable segment with tie-ups with Polycab, and we are doing with others as well.
So I think consumer durables would be an additional space that we're looking at. We've tied up with Whirlpool in that, and very recently we tied up with Saint-Gobain also, which is one of the largest glass manufacturers. So we keep on increasing our foothold in different industries.
Okay, got it. So anything that we are looking at, like in the near future, that any other new industry that we can see in the near future, maybe out of these in the next, say, 2, 3, 4 quarters, that can actually dominate, not dominate, but like take a good share from the automobile and construction sector as well, building material?
The diversification will be across sectors. Yeah, the building material space is initially heavy in our loan book because we started with our captive space of APL Apollo Tube. However, percentage-wise, it is gradually coming down. Secondly, automobile space is a very active space with very large players in the industry, with the quality of the dealers that are there who have been associated with those anchors. They have been there for decades with them, and the quality of the borrowers is also good. That is why we chose to expand in that space. When it comes to the other industries, yes, we are increasing our diversification, and probably we do not have any plan to concentrate only in a particular sector and grow only in that sector.
Understood, sir. Okay, thank you, sir. That was it.
Thank you. As there are no further questions from the participants, I now hand over the conference to Mr. Shripal Doshi for closing comments.
Thank you, Pari, and thanks to all participants for being there on the call, and thank you to the management of SG Finserve for giving us the opportunity to host the call. Thank you all and have a good day.
Thank you. On behalf of Equirus Securities, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.